Buyers are starting to fail near the all-time highs with seemingly zero excitement for a blue sky breakout. And honestly, that's based on a few bearish divergences that are just starting to emerge as we go sideways up here. The only bullish excitement that I can see is really just Micron earnings in the after hours. So welcome to the Trade Brigade Midweek Market Update, where we'll check out all of the data points and build a logical trade plan for the remainder of this week. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off with a closer look at the SPY daily time frame chart. The price action over the last 3 trading days has been absolutely brutal. The range has been compressed, it's been choppy. If you didn't know any better, you'd think this is holiday trading activity on declining volume down below. It's terrible. Now, we can sit here and criticize price action all night long. However, the more constructive thing to do is to read into the analysis and try to determine what's more likely to happen next, and also how can we use this information to manage our expectations. So if we stick to our core line of questioning, the overall trend still remains in the upward direction. Notice that we set a new all-time high on Thursday of last week. Friday technically holds as a soft high or low. The hourly trend was never firmly down in that interaction. And now we're trading right back into the equal highs on Tuesday and today's Wednesday session. So in theory, everything's fine and dandy. It's technically a bullish trend, and overall, the price action, the actual candle structures themselves, are not overly indicative of sellers gaining control. We have an indecisive doji, a long lower wick, indicating a hammer on Tuesday, and an inside close on Wednesday. Nothing crazy up here. So it's bullish until proven otherwise, but I do have concerns with the bearish divergences as well as an intraday interaction we'll talk about in just a second. However, on the daily, when we're thinking about the bearish introduction, when we were talking about bearish divergence, how do we actually want to action on those ideas? When do we participate to the downside? It's got to be on some sort of Brigade bolt lower high underneath the previous all-time high. This zone right here is of utmost importance. It's 566 to 565.25. It's a 75-cent zone. That's fine. If we're above that level, this is technically just bullish consolidation near the all-time highs, possibly turning into a bull flag. If we break down underneath that level, this is where now we have overhead supply. And even more importantly, from a weekly perspective, right, we have a look above and a failure back down underneath the breakout point. That would be the most bearish tell here from the highest time frame. So once again, there's nothing bearish about the actual structure itself. However, considering some of the divergences we're about to explore in tonight's episode, this is where I would action on the short idea. Should we be thinking about possible consolidation and breakouts into blue sky territories? I think the answer is absolutely. This is a consideration. However, let's take it on down to the hourly chart, and I want to show you why I'm slightly cautious of buyers really looking that great here. And it really stems from the first failure of the sellers on Tuesday. So let's talk about the story of price action here. This is Monday's range. It was probably the worst trading session of the week so far. Did nothing, sideways, small range, terrible volume. Great, whatever. On Tuesday, we opened on a gap up, and in the first hourly bar of the session, notice that we made a new 2-day low. So technically that is a bearish engulfer in the first hour of the session. A huge change in tone in terms of intraday momentum versus what we had on Monday. So great. Maybe the sellers are building an edge. What would we want to see? Ideally, if we're a seller, what is the next step? You want a lower high in the trend count. So either the ideal lower high underneath Monday's low, or heck, some sort of arbitrary lower high, maybe it's underneath a downward sloping VWAP, that would have been great. Where does Tuesday close? Tuesday closes way up here, back over the opening print, well above Monday's high. So great, that means that the buyers technically have an edge headed into Wednesday's session. Wednesday opens right here. We take out Tuesday's high. We test the key level at 572, and what takes place? There's a huge, I shouldn't even say huge, let me be careful with my word choice here. There's a mild, but relative to this range, substantial reversal back to the midpoint of the balance range. You would tend to think if buyers were excited about this reversal from Tuesday off of the lows after the sellers, just utterly failed to get continuation, this was like a gift to the longs on Wednesday's open. The fact that there was no attempt to get over 572 doesn't really leave me with a warm and fuzzy feeling inside. So What does that mean for tomorrow's session? What does it mean for the end of the week when it comes to pathing? I would prefer to trade outcomes that look like this. Consolidation continues. Brigade Bolt, show me an hourly, specific to the time frame here. Show me an hourly higher low over 572, and we'll trade into blue sky territories. Perhaps the upper edge of the weekly expected move can act as a target closer to 576. Great. That's your higher low outside of the balance range. This hourly higher low, and continuation is possible to blue skies. I would say that given what we've just walked through and also the bearish divergences we'll cover, seemingly lower odds. MU excitement in the after hours is trying to get the market going, but even NVIDIA's breakout today didn't really cause much euphoria in the market. So further consolidation without a higher low over 572, I think you're building out more of an opportunity for more longs to get suckered into the market and become disappointed when and if this starts to take place right here. And this is that daily breakdown underneath the key zone that we were just talking about, the weekly look above and fail. It's that 566, 565, 25. You've got an intermediate level in here as well. You can see the gray dotted line in there at 568.25. If you wanted to try to take a short underneath that into this, be my guest. If you want to try to set up like 2-minute chart risk reward that looks like this, fantastic. It's a scalper's dream inside of this range, I'm sure. But the overarching trades that we're looking for do not involve trying to get active in the midpoint of a balance range. You could flip the script and say something like, okay, off of this level, I think buyers are going to step up and send us to the top of the range. Again, if you can try for risk reward that makes sense like this, be my guest. But personally, I'm not sold on this idea because of the bearish divergences that we'll get to in today's episode. You know, I'm really playing these things up. I hope they're as good as you think they're going to be. Here are the anchored view apps intraday. I do want to show you that this consolidation thus far has taken place over the all-time high anchored view app as well as the FOMC anchored view app. So in this area, once again, it's bullish until proven otherwise. This we participate on the long side. If we start to drop this, we're underneath this first cluster, and then possibly, when and if, this is confluence up here, the breakdown lower high there starts to signal more of that short trade that we've been describing so far. So it's really patience and managing expectations inside of this range, with the best outcomes coming from a break and clear hourly higher low over 572, or a break lower high clearly underneath 566, 565.25, targeting this level. 550 on the downswing. Let's jump into the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Notice that on today's session, you really had the most severe of the internals reads. Monday is really lackluster, no surprise. Tuesday, same thing. Today, a little bit more severe. I'm not going to claim that it's substantial underneath negative 300 million, but it's more substantial than Tuesday and Monday. The net volume flows on the week are practically back to flat. If we're thinking about the advanced decline line, again, very lackluster days, Monday and Tuesday. Today, a little bit more severe, developing a trend to the downside, building a little bit more of that bearish narrative, if you will. If you look at the intraday index score, this should be like the cleanest indication to tell you to not touch the broad market with a 10-foot pole. If this is clinging to the zero line, if it's constantly flip-flopping back and forth, positive, negative, not a good day to be trading directionally the broad market, specifically the S&P 500. What else do you notice about the market internals? Look at the cumulative build here out of the tick today. Pretty substantial to the downside relative to what we've seen on Monday and Tuesday. Certainly not seeing any strong buy-side reactions during this recovery into the afternoon on Tuesday. This, again, builds a little bit, in my opinion, of this bearish edge as we're just consolidating sideways near the all-time highs. What about the market profile for the ES? I mean, you can see it as clear as day. Here's value from Thursday, Friday, Monday, Tuesday, trying to creep in the upward direction over these 3 days, and now just, overlapping to slightly down on today's Wednesday session. You have an incredibly poor high and poor low on the session, so I do think that those could use some repair. If there's a quick and snappy look above and fail, even on the balance range itself, let me go back over to the platform real quick. That would look something like this, look above and fail. As we mentioned, this is possibly short for a risk reward that looks like this, but generally speaking, the larger downside indication, which I will use a red crayon for, is going to come in underneath 566 and 565.25. this is where your bearish edge is really built. So I know it's like, there's not much price action to really read into, but the few indications we are getting are probably slightly more supportive of sellers getting active in this market, taking profit even near this all-time high zone versus new money buyers being euphoric about continuation in the upward direction. Let's flip this on over to the QQQ NASDAQ 100 and see what's going on from this perspective. This is where some of the divergence starts to step in. It's really the XLK that I'm concerned with, but we'll get there. This has tried to look over the top end, and you're getting some upper wick activity here. It's not the end of the world. You're still building out much more of a balance range here. We're trying to resolve 483 in the upward direction, but it's still not these confident, strong closes near the highs of the day that you would look for if you're trying to remain optimistically long. So generally speaking, just like the S&P, you have lows, higher lows, certainly an opportunity for higher lows over this 477, certainly an opportunity for bullish consolidation to persist over 483, but how strong is the move in the upward direction? Well, let's take a look at the hourly chart, and if you dissect the price action over the past couple of days, again, give credit where credit is due, bearish engulfer that then turned into a bullish close on Tuesday, great. You looked over Tuesday's high and closed back inside of Tuesday's range on the QQQ. I would have thought at least you could have tested the bottom end of the gap. You could have battled for, right? If you had stronger buyers interacting with this market, you could have looked for buyers to battle for acceptance over 488.50, especially with NVIDIA attempting a breakout on today's session. It's no love, closing back inside of that Tuesday range underneath the high. So not convinced we have the strongest buyers participating, but also, again, giving credit where credit is due, we did not get a lower high on Tuesday underneath Monday's range. So it's also not really fair to say that stronger sellers have emerged just yet, which really goes back to that mantra of the SPY daily time frame chart where we're bullish until proven otherwise, really looking for more concrete evidence that a stronger side of the trade is going to start participating sooner rather than later. Let's jump in here with the intraday anchored view apps to see where we stand from this perspective. Over the cluster, if you're over 483, I would continue to look at this through the lens of bullish consolidation with the opportunity for a gap close overhead. Because we have thin structure overhead out of the NASDAQ, it becomes a little bit more attractive to me to try to trade for that outcome versus blue sky territory in the S&P 500. That might be a little bit counterintuitive because it's like, okay, there's nothing overhead in the S&P versus the NASDAQ. You've got this clear structure. There is resistance overhead. I like that you can manage your risk a little bit better around these known levels versus the S&P where if you're in blue sky territories, it turns into a little bit more so guesswork, trying to stay over upward sloping VWAP, so on and so forth. I would be more willing to as well. Here's a takeaway in the QQQ NASDAQ. I'd be more willing to try to buy the pullback into 477. This looks more attractive to me for a pullback long opportunity off of this previous set of highs, 1, 2, 3 from back here, versus the S&P 500 possibly failing back down underneath its previous all-time high. So 477 pullbacks are a little bit more enticing on the NASDAQ, as we've just mentioned. Let's jump on over to the NASDAQ market internals and see what else we can learn about the underpinnings of this market. And this, I think, is telling for exactly what we just walked through, right? We talked about liking the long trade. We talked about liking the pullback trade there. What do you notice out of the volume flows? Not nearly substantial to the downside today, much more substantial to the upside on Tuesday. You did get an advanced decline line that was scratching at trend lower zone today, so we'll have to sort of take the caveat on that one. And a cumulative build out of the tick that was more substantial to the downside versus Tuesday's upside move there. But the volume flows do speak to some degree to buyers trying to get active across the NASDAQ as more of an exchange rather than just, trying to buy, let's just say, NVIDIA, like today's session, where you can clearly see the internals were bearish despite the move to the upside there. So with that, I think the NASDAQ is a better trader versus the S&P at this current juncture based on this supporting evidence. If we jump on over to the NQ futures, you can see that we've got a little bit more substantial progress in the upward direction at a value area. That's an overnight session. Let's omit that. So here's value on Friday, Monday, Tuesday is absolutely higher. We repair the poor high. We have overlapping to up here versus overlapping to down in the ES futures. MU is obviously going to have more impact on the NASDAQ versus the S&P 500. So I think the NASDAQ's the place to be in terms of looking for tradable outcomes, given everything we've sort of looked at so far. And by the way, if you're not familiar with the market profile video tutorial in the top right-hand corner, let's finish it up with at least the broad market, with the IWM cash ETF for small caps here. And this is where one of the major divergences step in. I sort of let the cat out of the bag with one of them. It's the QQQ NASDAQ, but really more so the XLK. We'll talk about that when we get to the sectors. But the first big one is the IWM. If you look at what's happening over here, yes, you're in the bullish upper third that we've been talking about when you split this thing into threes as follows. Absolutely, you're in the upper third, but notice that this pullback is absolutely trending in the downward direction. It's not like we have sideways balance here. So if small caps are moving lower, and let's just say that the NASDAQ cannot get in gear to get up towards that gap close overhead. Let's say that it violates the pullback into 477. With weakness already in small caps, it's absolutely a recipe for disaster in the S&P 500 near all-time highs. I would not want to be a breakout buyer into new all-time highs if the small caps are pulling back, if the NASDAQ's not getting follow-through in the upward direction. So what I would watch for here in the IWM is simply, do we remain underneath this level right here at 221.75? If we're below, I think it's all about 215 and the daily 50 SMA. If that gives, then just look out below. If we support off of it and start to do something that looks like this, it's up to the NASDAQ to put the bullish pressure back into the S&P 500. So this pullback here is divergent to what we're seeing in the S&P hanging out sideways near the all-time highs. Let's jump into the hourly chart. You can see and start to, from a pattern perspective, I think everybody could agree. Here you go with the head and shoulders. You're under the neckline. You're breaking down on today's session. You're underneath that 221.75. To me, you could still look for another lower high in here. That would totally be reasonable. You've set a lower low in the hourly trend count. You have highs, lower highs, maybe lower highs. You've got lows, lower lows, lower lows. Set another equal or lower high here and continue into 215. It's more bearish pressure for that S&P 500. Let's quickly check in on the anchored VWAPs, not the volume profile. Anchored VWAPs on the hourly. You're underneath the cluster from the most recent high, the FOMC high. You even closed today's daily bar underneath the breakdown origin anchored VWAP. Sorry, the low anchored VWAP. I'm getting these mixed up, but there you go. Low anchored VWAP, you're underneath, right? Whereas in the S&P and the NASDAQ, you're above, and those are possibly going to act as support. So this is a bearish headwind for the S&P 500 all day long. Let's quickly check in, because this pullback has been a little bit more substantial, on the Fibonacci's from the bottom up to the top. You're still over the 38.2, which is a decent indication. If you could stay over that, if this could support right here, right now, and get back into range and go sideways, it's a decent first step. But where do I become bullish on the IWM and therefore get bullish pressure in the S&P 500? Likely a recapture of that 221.75. It's got to be that. If it continues to drift lower, I don't see a world in which the S&P is ripping and roaring into new blue sky territories. Right? The excitement, as we've described so far, really isn't there. Let's jump on into the Russell internals and see what we can learn from this perspective. Lackluster Monday and Tuesday, more substantial volume outflows today. Remember, end of last week was definitely substantial to the downside. Advanced decline line has gotten to the zero line, if not negative, every single day of the week, more substantial to the downside today. And the cumulative build speaks for itself, also getting severe to the downside on today's breakdown. This is once again a headwind for the S&P 500. Let's jump on into the Russell futures and see what else we can learn. Again, very simple illustration: value area, value area, value area. Value area was, oh, look at that, inside. Not so fast. Value is certainly lower on today's session with a point of control almost smack on the lows of the overall session. Nice A period excess, great excess. You don't really have poor highs or lows to worry about repairing in the Russell 2000. Let's jump back on over to the platform. We've understood the first major bearish divergence, which is the small caps moving counter to the S&P 500. But let's look at the sectors themselves. And the second big bearish divergence, as we've clearly alluded to, is just the relative weakness out of the XLK. We'll get to that in just a moment. So at the top of the lineup so far, we have the semiconductor ETF up 2.8% on the week. That is technically more bullish in terms of posture. The XLY is doing quite well. That's a risk-on sector. XLB, it's basically the lightest weight sector in the S&P 500. It's not going to move the needle too much. It's not like the XLK is down, but it's definitely lagging relative to the S&P. At the bottom end of the barrel, it's the healthcare sector breaking down big time on today's session in particular. Financials as well lagging. So this is the third heaviest weight sector. This is the second heaviest weight sector. This is the first heaviest weight sector. some of these things aren't lining up, right? Your heaviest weight, I would say generally speaking, these two added up are going to outweigh your XLK. And again, you're still getting sideways activity. So this bearish divergence, even at the sector level, is continuing to play out. Let's check in on the structural charts themselves. So the semiconductors are resolving 237 in the upward direction, which is fantastic. The MU after hours move is also pushing this closer to 250 if you look at the bid-ask spread up here, which will be a bullish open for tomorrow's session. However, just note that we're not technically over this pivot high, whereas the NASDAQ, the QQQ itself, is trading at the equal high. It's trying to break over that equal high. So if this rejects here for a harsher pullback, probably spells pain in the S&P 500 into the end of the week. XLY, great move towards this next overhead pivot. Is there room for a higher low pullback? Absolutely. This chart is bullish, no doubt about that. Bullish in the XLY consumer discretionary. XLB materials, pulling back from a new all-time high on today's session. Bearish engulfer, fine. Lightweight sector, just the fact that it's made a new swing high is probably more bullish than bearish. However, the lightest weight sector will not move the needle. And here is the icing on the cake. This is the XLK major divergence number 2 in the lineup of tonight's episode. Just like we talked about in the QQQ NASDAQ being near that equal high and the SMH being near that equal high, notice that the XLK has the opportunity for a lower high. This is the heaviest weight, most important sector in the S&P 500 in isolation, and for that reason, I would tend to not look at this through the lens of like, oh my goodness, let's rock and roll into blue sky territories, right? So on today's session, upper wick closed right back at the high of the Tuesday session. I wouldn't really say that bears have an overwhelming edge here. It's just the fact that we're divergent from the broad market, which by itself is giving me some hesitations. I feel like I've sounded like a broken record saying this over and over now, but you get the idea. This is my main hesitation about the market near all-time highs when we're dealing with something that looks like this. Again, I want to be as clear as I possibly can be about not just running out there willy-nilly shorting the S&P 500 because, oh my goodness, there's these divergences. That's not the case. It requires the breakdown of that price action, which once again, I hope I've been crystal clear about. I don't want anybody to misinterpret what the point of this video is. There are cracks in the armor, but the actual price that pays you, the price of the index itself, is not yet signaling a short. XLK, we've talked about the concern here. If it's over 218, I would just give it the benefit of the doubt, try to aim for a higher low, and then I would be more confident on S&P 500 all-time high breakouts when this gap closes, when we get over this pivot high. That's up here at 228.15. Next up, XLI Industrials. I think I've got the main point of the video across at this point, so let's just continue a little bit faster. XLI, all set, higher lows available, new all-time highs, good to go, no concerns. XLP looks a little bit heavy here, looks a little bit head and shoulders-esque. If we break down through the neckline, that could be bearish pressure for the S&P, but not the end of the world. This is also lighter weight and deeper defensive, so if it breaks down, it's not really killer. XLU, new all-time highs, hanging out up here, putting in consolidation. Fine, technically deeper defensive, not the worst thing. XLV, third heaviest weight sector, breaking down through a double top neckline. I would expect continuation to the downside into 150-150. If we get there, I would look for support for a weekly higher low. If that steps up, so if we get the downside pressure, obviously Thursday might not go so well for the S&P itself, but when we get here, if we find buyers, that might be a great opportunity to say, okay, can the S&P support over the previous all-time high, and can we get the rotation just, balance rules in force, basically, if we just go back here? Can we get this pullback as the XLV breaks down to rotate back to the highs if the XLV finds support off of that level at 150, 150? Moving along to the XLF, similar indication here, looking like a double top is starting to pull back. Remember that the neckline has not broken down, and we could still afford a daily higher low over 44, noting that this low was way down here. If we could support over the 50 SMA again, that would be a bullish indication, building out a strong block overhead, longs off of 44 when we get there. So you can start to see the pattern here. If these pullbacks continue, not great for the S&P, but when and if we find support, maybe there's a long trade that unfolds back to the all-time high. Next up, energy. Crude has been getting absolutely smacked, and it's no surprise that the XLE is moving in the downward direction sort of in tandem with it. It took a while, but you did start to see crude rejecting off of these previous lows in here, finally pulling back on today's session, getting a little bit of an acceleration to the downside, looking to see if this can continue. And of course, this would be more of a concern for that big R word, recessionary themes, global demand for energy, sort of slowing down here. Crude is definitely not looking great. You saw on the headlines this morning, the crude inventories. We'll take a look at that when we get to the fundamentals. Let's jump into the TLT. Looks fine, honestly. It's just continuing to pull back a little bit, some profit taking out of the TLT, just driving rates higher. Which is not really, in theory, a great thing for the S&P marketplace. Let's jump into communications, new all-time high. So this chart looks bullish, but still lackluster up here. Bullish until proven otherwise, looking for this in continuation. If it turns into this, we'll look for a pullback into 85. Remember, a higher low can still be found there. Real estate is last but not least on the chopping block. Fine, trading near these highs, lightweight sector. Not really a bearish indication yet. New swing highs and lows for this are important for the S&P. Let's jump on into the actual ratio grid and see what's going on over here. If you're not familiar with this dashboard, check out the video tutorial in the top right hand corner. I like the subtle improvement out of the XLK, but it's nothing great. I don't like the breakdown in the XLF. I don't really like the fact that the XLV is breaking down so aggressively. More of a sideways trend here is important because remember, it's the third heaviest weight sector by market cap. If we're looking at the XLY, this is picking up some of the slack, but it's not really enough. I still would not call this market full-blown risk on, as we're trading near these all-time highs with the XLK ratio looking the way it does. If we look at risk off, this is really starting to settle down a little bit, which is bullish. This is going sideways, trying to threaten those highs. If it breaks out, that would be a little bit more of a red flag here out of the utilities ratio down below. Let's jump on into some specialized ratios and see what else we can learn. And over here, you're getting mild improvements, but you're not over double bottom necklines. You would need to make a new high over this one, so not there yet. Similar story over here, not even close. More so actually just a threat of a lower high, if I'm being quite frank. If we look at apples to apples, all set out of XLY, XLP, and this one's actually perking up a little bit with the breakdown in the healthcare sector today, paired with the NVIDIA breakout boosting semis. So this actually, it's getting there, but once again, what do you need to see? A new pivot high. We just haven't quite done it all the way. So once again, even these indications do not align with a full-blown risk-on market as we're consolidating near the all-time highs. Let's jump into, this looks fine with a little bit of an uptick here. We're holding. I like this hold out of NASDAQ relative to small caps. You don't really want to see massive small cap outperformance there. Let's jump into the dollar, which is really just stable down here towards the lows. If we throw in the gold contract down here, this actually might be a good place to start putting gold. Gold's been breaking out, and that to me is starting to signal, a little bit of, in line with what crude was suggesting, recessionary fears, right? Inflation round 2 style fears here as gold is breaking out, seen as a hedge against inflation. So why would gold be breaking out if everybody's going to be bullish, the technology sector on lower rates, and oh my goodness, it's the second wave of AI and everything's going to be so great? Gold's sending a little bit of a warning signal here, and we've been tweeting about that over the past couple of sessions there. It's not enough, once again, to get me to just outright action short in the S&P 500, but if we do spot that lower high, you better believe that the breakout here sort of adds to the confidence of that sort of idea. Let's jump into interest rates, and you can see that just like the TLT, right, kind of the inverse, moving in the upward direction, rates are slightly higher as bond profit takers are sort of stepping in there. And let's move into the inverted ZT. No issues, just kind of hanging out sideways by the lows. I would say that the largest concern really comes from the tracker tool, which is very early, by the way. I don't think we want to read into this with a strong indication. Remember, the meeting's on November 7th. Right? That leaves a lot of cycles of CPI releases and also labor report releases before we get concrete odds. So I wouldn't read into this too much that the market's forecasting another 50 basis point rate cut. I would take this in stride and just watch to see how the news releases actually impact the current odds of the Fed tracker tool. So speaking of current fundamental releases, manufacturing PMIs earlier on this week missed expectations, kind of a sign of weakness, not great. Probably why the 50 basis point cut is being bolstered a little bit there. Flash services PMIs come in hotter than the expectation. It's a key sign of sort of inflation in my book. So, I think the Fed, you guys know my thoughts. I've been very vocal about this. We don't need to rehash it, but I think it's a huge policy mistake, 50 basis point cut. What else? We had crude inventories, right? You can see, why is this not refreshed here? Let's give that a little bit of a refresh. There we go. Negative 4.5 million, which means that they're constricting more supply, trying to get prices of crude to go higher, even as demand is just not there, right? So they got to sort of artificially tinker with supply and demand to try to keep prices stable. And that's just, again, a reflection of possibly that R word coming around the corner based on the energy indications here. Tomorrow's going to be a loaded day with GDP on the morning session. Initial and continuing jobless claims. We'll really be paying close attention to that. Coffee and donuts up in the penthouse tomorrow morning. Durable goods will also be coming out, and then it's a loaded day of Fed speak. Jerome Powell is on the mic at 9:20. We'll see what type of commentary he has there, but look at all of the Fed speakers. They've got a party or something going on here, so just please mind the volatility on Thursday morning. Really, it starts to settle down once we get into the afternoon session. You get, Kashkari in the afternoon, but he's already spoken earlier this week if we go back to the top on Monday's session, so it shouldn't really be changed thoughts. You shouldn't have any, dramatic new opinions over the span of just a couple days. Friday is PCE, not worried about it. It's really the next CPI release that we're concerned with. If we just look forward in the calendar to when that is, we know that it is, this is the labor report week. It is the 10th, I believe. Yes, 10th of October. There you go, Thursday, 2 weeks from now. This is going to be major market moving information, in my opinion, to determine whether or not the market pricing in the first rate cut is going to be enough to spur a second wave of inflation. So October 10th is really where I would say you want to start, thinking more concretely about what the odds look like here out of the Fed tracker tool. It's been a pretty quiet week fundamentally so far. Things will heat up next week with the labor report. Here we go with the earnings calendar. We talked about Micron in the intro, Costco after the close tomorrow. Costco's just on a rampage on something like a monthly time frame chart. It's not really the best day trader, but certainly as a long-term buy and hold, man, that's treated a lot of people quite well. Let's jump back over to the platform and start to take a look at a few things. We want to do risk appetite first, but then we'll tap back into MU because it was an earnings candidate in just a moment. Here's TLT ratio to the S&P, making some sort of equal low. The reason I bring it up, usually we skip it when it's not doing much, but if this breaks down, probably supports the idea that you don't want to be aggressive short in the S&P 500 as long as we're above the previous all-time highs. So watching that ratio quite closely. If we look at bonds relative to themselves, small upticks are continuing here, but still counter trend moves in the context of bigger downtrends happening here. No concerns. Let's take a look at credit spreads. Small uptick, but once again, counter trend moves in the context of existing downtrends. This is still bullish. Let's take a look at the HYG because this is big bad divergence number 3. The HYG has had a positive divergence from here to here while the S&P was going more so sideways before it finally got that sort of follow through into the gappy end of the week last week. And the HYG was signaling this bullish divergence the entire time. Now the HYG is signaling a little bit of a bearish divergence, actually making lower lows into the afternoon, whereas the S&P sort of has this higher low. If this one's not concrete enough for you, you could take a look at the LQD, which is just corporate grade bonds, and you can see the same thing. Lower high, lows, lower lows into the afternoon, when originally this was suggesting that we had a bullish divergence between here and here. So it was right the first time and it brought the market higher. Is it going to be right the second time and bring the market lower? Once again, we talked about in the intro, I wanted to be extremely clear that we're waiting for the lower high in the index itself, but this would be a proponent of that possibly being a likely outcome. Let's jump on into, we'll move along to Bitcoin now that we've covered that final big divergence. Bitcoin's just inside of range, not really doing much, no big indication there. Breadth is pulling back a little bit here. You can see mild downtick out of the moving averages, as well as new highs versus lows. Nothing earth-shattering. It's not like, oh my God, markets are going to zero. And you can see that reflected in the RSP as well. Still sideways consolidation. The equal weight did see a little bit more downside today, down about 62 basis points versus the SPX down 19. You're just looking at this 19 versus this 62, and reason being, as we all know, is just NVIDIA, the heavyweight one stock to rule them all, was keeping the S&P propped up a little bit better than the equal weight. So still not the worst thing I've ever seen, and as long as we're over 175.85, honestly, I would not throw in the towel and say once again that everything needs to crumble and go to zero. If you can hold this here for consolidation, good to go if we get follow through over time. If the RSP comes down underneath and does something that looks like this, left, head, right shoulder, right? Now all of a sudden, this is looking like an attractive and executable short on the lower high underneath the all-time high zone in the S&P itself. Let's jump on into an equal weight NASDAQ is going to be the same. No issues over here. It's been pretty much one-to-one with each other for a while now. The Dow transports are still divergent to the breakout out of Dow Industrials, so maybe keep that as a feather in the back of your pocket there as a bearish indication. We'll finish up with the volatility indexes here before we jump into MU, the core list, and 3 additional ideas. 15, if it breaks down, probably more bullish, looking for just upside drift. If this starts to re-accelerate and perhaps Jerome Powell is the catalyst for that, let's think about what's on the horizon, right? If Jerome Powell is going to be the catalyst, then any acceleration off of 15 to use that as support, hey, maybe it's looking attractive for that break lower high underneath. VVIX, volatility of volatility. How do we make out over here? still trading near this equal low. Again, if it perks up, you'd probably, to have larger concerns about deeper pullbacks, you'd have to get over 103. Here's a trade idea for you. If the VVIX perks up, but it only sort of tops out under 103, I would start thinking about, okay, probably a buyable pullback here, not throwing in the towel, not looking for huge shorts, but just, letting the pullback unfold, then trying to spot the turn back in the upward direction if this tops out at the 103. Let's jump into volatility futures. We're in a very mild backwardation here. I'm kind of a believer that this is still due to the contract roll. You can see here we're still in contango out of the 9 versus 30-day VIX, and out of the 1-day, you're actually floored towards the lows. So this is actually a little bit more healthy for bullish activity, believe it or not. Let's just go over here for our core list of companies, and let's begin with Micron to start. This is going to be gapping up towards, you can see in the after hours here, 109.90. 109.90 actually brings us over the pivot high, or at least the opening print of the red bar. So Micron tomorrow morning is going to be a huge watch to determine whether or not we stay over 108.85. That's the level that I would encourage you to use. Of course, from a double bottom perspective, it's going to act as your neckline. It means that we're instantly going to get some sort of higher high in the trend count. We're over that key inflection point. If we hold it, there's thin structure to retrace off to our left. This gap is probably what you want to start thinking about as a possible target here. So this is not even intended to be one of the additional trade ideas for today's episode. However, because earnings probably make this something to, as a top watch for tomorrow, this is what I would be thinking about here in real time. So opens above, thin structure to retrace overhead, looking for upside drift. You could probably pay attention to this level, 113.85. As an intermediary, it's that sort of flat low before this final, ugly leg to the downside. 1, 2, 3, 4 equal lows, used it as resistance. So that's a possible idea. If the market gets underneath in MU 108.85 and is fading the gap, you could look for shorts as long as the risk reward is meaningful enough. I'm just not sure I would overstay my welcome if everybody's looking for hey, semiconductors are waking up. We saw the SMH was over 237, right? NVIDIA had a great day today. We'll see. I would not be swinging for the fences on the gap close indication here out of MU if the grind to the downside does begin in the first place. Anyways, Apple is up first on the chopping block. Apple's been a pretty tough trader past couple of days with the broad market. Notice that we had a 2-day balance range. Here it is, Monday and Tuesday, Wednesday. It opens underneath, rallies in, rejects, comes to close back within. So all over the place out of Apple. I don't really think, let's rewind here and just talk about the ideal setup earlier on in the week. Monday, the idea was, okay, can we short a lower high here for thin structure through this outcome? Well, did the sellers accelerate? Did the sellers accelerate? Did the sellers accelerate? No. We did get downside drift, but there was no strong actionable idea there to actually short Apple in the first place. So one step at a time. If this is look below and fail, a higher low over 226 might indicate the top of the range. My preference at this point is probably something that does this, especially if the broad market itself is kind of in limbo. Let's jump into Microsoft. Great lower high opportunity here. So daily chart first, actually. So balance range, right? If that balance range is going to act as overhead supply, now we can go to the hourly. This rejection, which you're starting to see in these upper wicks, wants to pull back again. If that's not going to float your boat, because on the daily you're saying, no, Matt, this is a double bottom, this is a higher low opportunity over the neckline, then what you need to see is you need these upper wicks to be absolutely abolished, right? You need to see some sort of price acceptance over 432.15. What kind of vocab word was that? Goodness, abolished. 440.65 on the upswing would start to look attractive, maybe something that does this for risk reward. The other opportunity, and probably my preference out of Microsoft, would be fine. Let the sellers push it down again. Turn this into a double bottom on the hourly chart as the broad market tries to figure out what the heck it wants to do. Then when and if this resolves to the upside, great. Bullish over the neckline of this, trading into the equal high, if not further, for a higher high on the daily up towards 448. So trying to apply a little bit of forward thinking out of Microsoft as to what it could become. This would be an idea that would be very attractive over time. If it does this and gets weak and starts to flush, we'd have to reevaluate from the daily perspective. Next up, NVIDIA, the one stock to rule them all, finally woke up. We were tweeting about it. Wake up this morning. There it was. So on the Tuesday, let me get my days right, Tuesday afternoon session, beautiful consolidation over the highs, nice continuation out of it today, and we did get a little bit of a pullback. So I think referencing the daily chart, you can see we now have lows, higher lows, higher lows. No longer do we have the threat for lower highs. This is sort of like from here to here, a higher high. So the trend is trying to build out to the upside, which means that any subsequent pullbacks here need to hold up over that previous pivot high. 120.50 needs to act as support if this is going to build its next block and possibly rotate into this equal high. If it does get solid continuation to the upside, it's possible it could take place, but looking back at this structure, there's a lot of, there's a lack of clarity sort of inside of that zone. I wouldn't really think that there's crazy opportunity for a huge upswing into 129.50. Next up is GOOGL. If we take a look at GOOGL, we've got ourselves a balance range here. Nothing really constructive to talk about out of this one. Equal low flush maybe gets you down to the bottom end of the range. This is where the daily higher low wants to be found. If it's chopping around up here, let it do its thing. This would be where you want to get involved on the long side over 164.75. I'm going to have to speed this up just a little bit, so just got a quick message here. Amazon looks great on the pullback here. Ideally, consolidation, break, Brigade bolt over 195.75 brings you into the all-time high. As long as this is trading over this kind of 190.85, no big concerns out of Amazon. Bigger bears step in when and if there's a lower high under 189.25. Metaverse, what do we see over here? All-time high grind continues. I like the hold of this level here at 566.50. Any continued consolidation is just Brigade bolts over previous day's highs into blue sky territory. Sellers only have an edge on this trade right here from A, underneath 556.25 to B at 542.50. And even when we get to point B, it's a huge flat top retest. This would be a possibility for a daily higher low. Next up, Tesla. Nice little continuation out of the gap close here, follow through to the upside. This flat top is giving us a little bit of a struggle here, an inside bar on today's session. So inside bar means that we just use basically balance rules. And over this top with a Brigade bolt, great. Follow through to the upside, $266.30. If it's pulling back, I shouldn't even say chopping around. If it's pulling back, I would look for pullback buy opportunities around 244. Next up, JP Morgan. It's kind of acted as a slug recently, but I do like the beginning stages of this hourly trend reversal. You have a balance range, you have highs, lows, or I should say, look above and fail. Let's slow down. I do have to speed up, but slow down a little bit. Highs, lows, lower lows underneath this shelf. To me, the hourly trend reversal is underway, which supports the theory of a daily lower high being found here from here to here after the failure to pull back and support over the previous highs at 215.75. So a little bit more bearish out of JP Morgan. Netflix starting the breakout in the upward direction from the daily bull flag. Obviously, continuation out of this has a lot more to go in terms of measured move. You did look above and not really get much acceptance above on the hourly chart today. So is it possible that this emerges as this, pull back to here? I would look for a big area of support. This has been fairly choppy through this zone. You can see how many levels I have stacked up there. It's kind of a back burner idea. I think swing longs are probably the idea, not really intraday scalps. AMD, beautiful, beautiful trade today. Another one that we've been tweeting about and following very closely. Great hold in this level. Brigade bolt intraday over 159.25. Here it is on the 5-minute chart just because of how pretty this thing was. Look at this. Boom, boom, boom. Higher lows continue, higher highs, higher lows, right? Beautiful trade there intraday. AMD is almost, a little bit less volatile than NVIDIA, but definitely just a great opportunity. I like that there's a lot more room to run overhead. So watching and continuing to watch AMD for further overhead into 169.75. 3 ideas. Visa is up first. We're speeding through them. We've got this big zone to be watching here, looking to see if panic dip buyers want to step up. No indications yet, but watching to see whether or not we could put in something like this, daily hammer candle, then rotate back in the upward direction. Equal high would be the first intended target. Notice the thin structure on the way down. This is still a 5-minute chart. Here's the hourly. You can see what I'm getting at, right? Stevie Wonder is possible here if you get an open over. I would say you want an open over 271 could unlock a Stevie Wonder to the upside. So that's Visa. Next up is Disney. DIS is the ticker here, of course. And what we're looking at is a daily double bottom triggering with consolidation over the neckline. Looking to see if we can get follow through over 94.80 and 98.30 is the target in play as long as we're over 91.80. And then finally, I know we're speeding here. Let's go on over to ARM. is the final idea. Semiconductor space, MU, we've got some catalysts, right? It's opening, or at least in the post-market, it's trading 148.40s by 49. So in this general zone, thinking about, once again, thin structure retracement overhead, Brigade bolt, break out of this flag. This flag is happening over the neckline of the double bottom. It's all set. So with that said, we are going to finish up today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live tomorrow morning in the Penthouse studio with coffee and donuts for the Jerome Powell speech, durable goods, the jobless claims, everything that we just talked about. Come hang out. We'll be live, kicking it off at 8 a.m. Eastern time here on the channel, free and open to the public. We hope to see you there. Have a green trading weekend. As always, I will see you in the next one.